How do we determine your income and therefore how much you qualify for? So a little while ago, I made a video on determining income, how much you qualify for your regular buyer. What happens if you're self-employed? It's a little bit different because you don't get pay stubs. You might, but that's the subject for another video. You don't get W-2s. And so how do we determine how much you make? Okay, so if you remember my last video, we were looking for your qualifying monthly income. Self-employed borrowers, generally speaking, are going to have their business set up in one of two ways. These are the most common. An LLC, which is on the Schedule C of your 1040 tax return, or an 1120. Those are just different ways to organize a business. So what we do as mortgage loan officers is we will get your last 2 years of tax returns, and we're going to look at either the Schedule C or the 1120, whichever way you have it organized. We're going to go through there line by line, looking at the figures that your CPA has put in those different lines. We're going to be adding some of those numbers. We're going to be subtracting some of those numbers. In the end, we're going to come up with your monthly income. Now, why are we going through this line by line and adding some figures, subtracting some figures? So, as you know, as a self-employed borrower, as a business owner, let's just say, for example, you made $100,000 last year. You are going to write off a bunch of your business expenses. Therefore, you don't have to pay as much taxes to the IRS. So let's say you made $100,000 last year and you wrote off $40,000 in expenses. You are telling the IRS that you made $60,000, and that's what you're going to pay taxes on. So what we do is we come up with that figure. We're going to see, okay, $60,000. That's why we're doing the addition and the subtraction. Your adjusted gross income, your taxable income, is $60,000. And that is what we are going to use to come up with your monthly income. $5,000, just as in my last example for your regular borrower, $5,000 a month, 60,000 divided by 12, and then we are going to subtract your liabilities from that, again, just like we did last time, to come up with your qualifying monthly income. So where it gets tricky with your self-employed borrowers is you make a lot of money, you don't want to pay a lot of taxes, so you're going to write off a good amount. The more you write off, the less taxes you have to pay to Uncle Sam. However, if you are looking to purchase a home, that's where the balancing act comes in. The more you write off, the less money you make, and the less you will qualify for when it comes to buying a house. So when you're looking at buying a house, get with your CPA. You might have to write off less, pay a little bit more in taxes to make sure you qualify for the home you want. I hope this didn't go too long. I hope it made sense. If you have any questions, feel free to reach out. And until next time, stay cool.